everybody, it's Chris with Life 180, and this is going to be a fun video. I am really looking forward to it. So I'm going to talk about index universal life, whole life insurance. It's been a little while since I've really tackled into this, and I've been working on some stuff on kind of the back end of everything I'm doing. Really trying to put together some good educational stuff. But at the end of the day, here's the deal. I just got done putting together some illustrations. And ultimately, what I've been trying to do is, a lot of people think that I dislike Index Universal Life. And the reality is I don't dislike Index Universal Life. I just think it's one of the most missold products in the world. And so the purpose of today's live, and I wanted to do this live because I want to be able to check and engage. If anybody wants to be able to talk to me, I don't want any edits with this. I'm probably going to bounce around and stumble a little bit because I have 4 different illustrations that I'm working off. I have 3 different assumptions for IULs, and I have another assumption for a whole life policy to kind of compare them against, right? They're all designed a little differently. I had agents put these together for me. I had them all kind of like constructed to be able to really take all the different variables into consideration. And I want to be able to go through the illustrations and really talk about what's what in the illustration, just so people understand all the different moving parts. And so that said, what I want to be able to do is just hop right into this. So I'm going to actually share my screen here and go from there. Let's do that. All right, so let's get into this a little bit. So now what I have here is the Nationwide Accumulator 400 product. I know that there are a lot of people that like Nationwide out there. Going into this, I just want to kind of go down through this. This is just some of the disclosures and descriptions about like what is this stuff. This is the 2020 product, and so here's where it gets into some fun stuff. I'm not going to go through this all in detail. I will scroll slowly if you want to read the contract in full, but I'm going to get to kind of the core of everything, and really touch on the points that I think are extremely important, so to speak. And so let's go down to this page right here. So this basically goes to show you they have 1, 2, 3, 4, 5 indexing strategies for this policy. And so for this policy, people can choose to participate in different index strategies. You can see here, there's a 1-year high cap multi-index. So there's a 20% cap rate, 4% guaranteed. If you look down underneath there, it sounds really good, right? 0% floor, 4% guarantee is the lowest that the cap rate could go, 20% on the high. Seems really awesome. 7.03% is the maximum allowed to illustration that agents are, according to AG 49, Rule AG 49. It limits the amount actuarially that agents can illustrate these policies at. And so from that perspective, I think you'll understand when I come through this why that is too high. This is kind of the summary of the terms: the cap rate, how much you can earn every year, the floor rate, how the protection, the participation rate, if it's saying you're participating in the market with a cap rate of 10%, for instance. If you're 100% participation rate, it means you can earn up to that 10%. There are some companies, 140% participation rate seems to be a really common participation rate in these policies. And so if you had 140% participation rate with a 10% cap, that means you could earn up to 14% for a cap rate. That's not in this policy, but I'm just kind of terminology helping you out. Spread rate, like that's indexed interest strategy charge rate. The charge is assessed at the time an index segment is created. The charge is calculated by multiplying the dollar amount being applied to create an index segment by the applicable indexed interest strategy charge rate. So basically, the indexed interest charge rate is saying we're going to charge an interest rate. We're going to pull off of the account value. If you have $100,000 and you take a $10,000 loan and you use the index interest strategy, it's going to take $10,000 out of against the policy, and it's going to credit the interest that earns and the interest that you are paying on that loan is going to function different than it would in the other strategy. And so let's see here. I know the other strategy is listed here somewhere. I will get to it down here. It's somewhere here. Minimum required fixed interest strategy. That's what a dollar amount equal to the estimated monthly deductions for a 12-month period, assuming no changes to the policy during that policy year. This amount is determined each year. Oh wait, no, that's not the same one. I'll find it here. It's down here somewhere. Declared rate loans. That's the one. Declared rate loans, a loan option under which money borrowed against the net surrender value is credited and charged interest. So it's basically, this is the wash loan, right? This is basically the wash loan that's important to understand. So any policy loan will be charged. So for declared loan rates, check this out. It makes it look really good. They're saying any declared loan rate, because it's basically a wash loan, is going to be charged a guarantee of 3.9% for the first year, or first 10 years, 1 through 10. You're going to pay 3.9% for a loan rate. It will go no higher than 3.9%. Here's where this is where I think it gets really shady. They illustrate, and it makes it look really beneficial when they run these illustrations, because year 11 plus, which is typically when the loans are coming out of these policies, and that's why they illustrate it like this. Year 11 plus, the current rate, because that's what's illustrated, is the current rate of 3%, but the guarantee is 3.9%. And guess what? I promise you, by year 11, this is going to be 3.9%. I've never seen it not be at this rate of 3.9%. It's what it's doing now. So what they're saying is when we get to that point in time, we're going to reduce the interest rates. And a lot of people say that they say they're going to reduce it because of the fact that there's expense ratios, and they give you discounted fees and longevity benefits of having the policy in place by then, but it never happens that way. They always keep that fee at 3.9. The reason they do this is because they're allowed to illustrate any loans coming out of this at a lower rate, so it builds in more arbitrage and it makes the policy performance look even better. So that's important to understand. Alternative policy loans, a loan option under which the money borrowed remains allocated to the selected interest crediting strategies and continues to receive the interest credited to those strategies. So alternative policy loans are basically, they are policy loans where instead of a fixed wash loan, like a declared rate loan, an alternative policy loan is going to allow you to participate in arbitrage, meaning if the policy has a 10% cap rate, then you can earn up to 10%, but you're going to pay the interest in that account. So in this situation, the maximum that you're going to pay for a policy loan is 8% here, but they illustrated it 5%. So when I say there are a lot of levers that move inside of these policies, this is one of the levers. They can increase your charges for policy loans when you're trying to take advantage of that arbitrage. So remember, these always illustrate at the best case scenario for you, the insured, for the person who's buying for the policyholder ultimately. And so when you look at this is saying they're illustrating at the current rate. The current is always what it's illustrating at right here, right? And so they're illustrating it at 5, but they can, remember, there are different ways. I talk a lot about reducing cap rates. They can increase loan charges too. When you're looking to use these things for income, that's a huge deal, because if you're paying a 5% loan rate versus an 8% loan rate in 20 years, that's a huge deal. Think about that, what that does to the potential of the growth of your policy. It just crushes the policy, because internal fees, when you jack that, remember, a 5% to 8%, that's a 60% increase in loan fees, right? So if you increase the loan fees by 60%, it's going to just decimate potential growth value of the policy. So I'm not going to get into a lot of this. It talks about a lot of different stuff. This is just, I want to get into some things here and just get down to the pertinent parts of the policy. I'm not even going to go through the guaranteed part. I'm going to skip over this. I'm going to get to the non-guaranteed, which I think is important to get right to. Here we go. So here's the deal. I did this on a, looks like a 41-year-old, but they're showing 42 because it's the age at the end of the first year. So it's to take into consideration. I did a $10,000 annual premium, as you can see here. I'm going to actually zoom in a little bit and see if that helps. I did a $10,000 annual premium, and you can see here that right here you have the accumulated value of 85.21. So that's the amount of money that is earning credit, is going to be able to grow from a cash perspective. And then you have the net surrender value, because one of the things index universal life contracts do is they have surrender periods, kind of like an annuity have, where your money is tied up in surrender charges to make it so your money is basically stuck and you can't access it, and you're kind of committed to the policy. And that's one of my big challenges. It's hard to get a lot of liquidity in these things right away. Now, can you do it? I want to be the first to say that yes, you can do it. There are ways that you can put money into an IUL in year one and have 100% liquidity of that money. However, there literally is like zero income to be made on that by a life insurance agent, and that's why you A, don't see a lot of people doing it. B, there's other restrictions that go with that. So like that, I'm gonna get into that in another video. But like for this scenario, I wanted to show kind of a generic apples to apples comparison of what the policies can look like. So you can see you put in 10,000, you only have 4,761 available right here. Now I don't remember, this is showing, this is showing, this is a 4% rate. Actually, I'm not gonna go through this one first. I wanna go through, this is the one that actually most people do first and foremost here. Let me go through here. This is the non-guaranteed rate. So up here, let's go through this. I'm gonna go through this, is the assumption of, let's go, the non-guaranteed assumed interest rates, that's right here. This is what most people sell these at, the 7.03 assumption. So that's what this is growing at. And then the non-guaranteed alternate interest rate, that's the 2.75%. That's right here, that's this middle column. Now here's the deal, I wanna tell you this. 10 years ago, this middle column didn't exist. This exists solely because there's been so many lawsuits on these policies that the companies had to put these in play, because listen, you can, if you sold basically off this alternate interest rate, nobody would ever sell a policy. But with AG 49, you're allowed to illustrate these things at much higher rates. But the problem is, it's never going to meet these higher rates. And so what they do is they say, listen, this is insurance. It's not an investment, even though everybody sells it as an investment alternative. This isn't an investment. So to protect our butt as a life insurance company, we're going to create this column. So at least it's like buyer beware scenario, and you kind of go from there. So before I go any further, I want to just check over here. I got to check my screen here and check the chats, see anything. Yep, Zoom helped. All right. Hey kids, what's going on? So yep, so I'll be checking over here every now and then. I'm gonna just be checking in, and I'm just gonna continue on this here. So here we go. So you can see here that at the 7.03, what I want to do is just kind of go through and look at the assumed values. This is why, because most people look at this at the 7.03% rate and the assumed rate in the net surrender value, and you look at here, it grows. By the time you hit year 65, you can see here up to 66. That is at the end of age 65. When they turn 66, it's got $504,000. So you can see here, if I said, hey, you have upside opportunity, downside protection. You put $10,000 a year in, you put $250,000 over a 25-year period in, it's going to grow to $504,000. It seems really good. Out of that, you'll be able to, get a certain result, and it'll be what it'll be. But here's the challenge. A, they're never going to perform at that 7.03%. It's just not going to happen. And I think I had an internal rate of return. Let me see here. IRR. Yep. So I have the internal rate of return account here, and you can see here by year 25, the internal rate of return on surrender value is 5%, 5.04%. That is insanely awesome, right? And I know why this looks so good. Believe me, if they worked like this, I would just jam all my money into one of these things, because there's not another vehicle on the face of the earth that would do this. And I get why these people are doing so well selling all these things, and it's one of the top growing products in the world, because like people are selling with these assumptions, and they just do not work like this, folks. They just don't. So here's what they do. Let me see, which one is this. So what I did is I dropped it down. I'm gonna actually go back here. I'm gonna try to get it back up to the right area, because I want to be able to go back to the right assumptions. Where is it here? All right, right there. So 504 is what we're at, 504 in value. So I'm going to go down to that page. And non-guaranteed. There we go. So let's zoom in a little for y'all. Let's go there. So we dropped the assumption down to 5%, which is, you know, when you look at all the variables that come into play, because remember, it's not about the rate of return in the S&P 500. That's what I need everybody to understand. It's the fact that they have all these moving levers, the fact that they can reduce cap rates, they can increase charges, they can increase loan rate charges, they can increase all these different moving levers in the policy, that even if the policy has you know, more cash in it, let's say even if it had that $500,000, $4,000, because it's not pure, it doesn't mean that 504 is going to act like it's showing on the illustration. So what you need to do is you need to illustrate at lower assumptions to take all the moving levers and moving parts out of the equation, because they don't allow you to illustrate like, what's it look like if the loan rate goes up to 8%? What's it look like if the cap rate comes down to 6% or 8%? What's it look like if all these different levers move? So you need to just build in assumptions that are going to be safe and secure. And so what I did with this one is I also threw in a little income. So, but here's the deal. Look at this. If you're sold this, imagine you buy the policy and you buy it because you're thinking, wow, this is fantastic. I'm going to get a $504,000 chunk of change. I can leverage that. I can use it. I'll have access for tax-free income at retirement. A lot of people are going to illustrate income off that and whatever. That's fine. Here's the deal. I did illustrate income in this one. I didn't for the other one. But you can see what happens. This is where it gets really nasty, right? So they tell you don't have to pay back the interest on the loan. And this is where it like blows up in people's faces, because here's the deal. Now within a 5% assumption, I go down to 376,000, right? Is my accumulated value. And that's a more accurate number, by the way, because of cap rate manipulation. But let's take it the next step further. What they're going to do is they're going to show you 14,556. This is a loan. So what this is showing income, because I'm taking a loan against the policy for income. And so the loan balance is 14,947. Why? Because I'm having to pay interest on that. And so that is what it is. But here's the bottom line. This is assuming a 5% current interest rate on your loans. Remember, they can jack that up, and they will jack that up 10 to 12 years from now to 8%. So you're not going to be paying 5%. You'll be paying 8% if they need to. I'm not saying they're guaranteed to do that, but I promise you, if you're going to be building a vehicle for your financial future, you don't want all these moving parts that you don't have the variables or clarity around how they're going to react, right? So that's a huge, huge deal. I hope that makes sense, because if this goes up, because when you take the loan as income, it's the compounding expense of it. So you're paying not the 5%, but the 8%. Let's assume that for every year. By 4 years into this, you've taken $72,000 of income. You have $82,000 in loan balance here, but if you add in 60% more interest, which is what a 5 to 8%, remember, is, it gets way worse, right? Like, so remember, and you can see up here, I've changed the assumption from 7.03%, which is what they, on a standard basis, illustrate at. I've reduced that to 5%, and I've done that on purpose. A lot of agents just don't do that. You should always be testing these at a stress test. I think 4 to 4.5% is the stress test level that will say, okay, with all the moving parts, if it still performs well at 4%, then you're okay. It's not going to blow up on you. And so I just wanted to show this at 5% first and kind of talk about it. But you can see that, you know, this one gets out there, and with this assumed rate at 85 years old, at 2.75 at the alternate rate, it lapses. The policy just implodes because of the costs and all these different variables that move into play. Mind you, the accumulated value is going up. The loan value is only, the total loan balance is 456. But by the way, if you had all this loan balance at 8%, getting bigger and bigger and bigger, this is going to compound faster. And by the way, you're going to have this policy, if they raised loan rates in this scenario, this policy would pretty much lapse around this time as well, maybe a little later, maybe 86 to 90, which, you know, you could argue that if you're going to live longer than that, you know, not many people are going to live longer than that, but I don't know. I think there's a good chance people are going to live longer than that. So you want to make sure you're prepared and you have a strategy that's going to build it in there. So, all right, I was just checking over to make sure that I didn't have any more comments. So I don't. So I'm going to get back and get back to it here. Let me switch back and go. All right. So that's that. Now what I did is I said, okay, let's stress test this thing. Let's get down to the 4%. And let's build these assumptions. Because remember, I don't hate IUL, because you could see this actually ends up not being horrible. It's pretty decent. It's not going to hurt anybody, right? Now, is this guaranteed what I'm going to show you? No, it's not guaranteed. But it is what it is. Like, you know, so you can see here the surrender period. You know, you still have that 47.61 the first year. We have the 4% assumption, right? That's the what we're going to assume is the average rate of return. And I'm coming to that conclusion for a lot of reasons. I really, history shows cap rates are going to come down. And it also builds into account that I can't illustrate that loan rates are going to go up and all these variables are going to go up that I showed earlier. And so that's something to take into consideration. But you can see here, it's not even in year 10. You haven't even broken even, right? Like if in year 5, you've put in $50,000, but you only have $43,000 liquid. In year 10, you've put in $100,000, you have $98,000 liquid. Not even. You're barely breaking even in year 11, right? So, and that's, once again, that's not even guaranteed, right? Like that's, and not only guaranteed, because I understand whole life has a guaranteed column and a non-guaranteed column. But the thing is, with a non-guaranteed column in a whole life policy, it's a lot more likely to happen, especially with all-time low dividend rates happening right now. It's much more likely to happen. And so let's go down here to year 25, age 66. And now the account value is all the way down to 326,000. So if we look at that here, we're at 5%, you're at 376. But remember, this is what you were sold on, is the 504. So if you really put this down to stress test it and run it at 4%, and you have the assumptions in place, you're at 326,000. Now remember, that also affects the income that you're assuming, because listen, I don't know why anybody would buy an IUL if not for the income. And so the problem is, you can see the drop off in income, and I should have done it. I don't know why I screwed up there. I apologize. But you can see the drop off in income from 5% to 4% went from 14,000 in income to 8,000 in income. So that was a 1% drop, right? In that, literally dropped the performance of the policy from 14,000 a year to 8,000 a year. So that just goes to show what the internal charges and fees of these policies do. It's disgusting, right? And once again, this still is not showing the 8% potential loan rate. It's showing best case scenario, 5% loan rate on this loan. And here's the deal, if I were to run this, and I wish I had done it, man, I'm sorry, I didn't have it done. Maybe I'll do another video on it showing it. But if I'd shown this, because of the fact that I have the 7.03 assumed rate, it would scream amazingness, because it builds in that natural arbitrage in the illustration, saying, well, you're earning 7.03 every year, and you're only paying on the policy loans 5%. So there's a 2.03% arbitrage that, even though you're taking a loan out, taking a loan against it, it's going to continue to grow because you're earning more than you're paying. We all know real life doesn't work like that. That's why these things are dangerous. They illustrate amazingly every single time, but they never perform as illustrated. And I hope you can see why I'm saying that. Now, here's the deal. When we come here, that I probably at the 7.03%, I bet you this would illustrate at like $40,000 or $50,000 a year of income. And it really, imagine if you were banking on between $30,000 and $50,000 of income a year, 25 years from now, and then you ended up only getting $8,100. That's my big problem with these. Even if they don't lapse, even if they don't implode, they're never going to help you reach your goals. They're never going to get you where you want to go. And so when you look at this, let's look at the assumptions here. This gets you at 25 years, $326,000. Now, here's one of the reasons that I don't like IULs, because what I'd like to do here is I'd like to dump money in. I'd like to say, I want to put more money in, and I can, but the bottom line is by putting more money in to an IUL at the beginning, you lose liquidity of that money. And so it's a bit more restrictive, right? So I talked to people the other day that put a bunch of money into an IUL, like almost 100 grand, and they lost a lot of the liquidity of that money. And so, you know, at least for the first couple of years, it's not that it wasn't earning interest. It's not that it wasn't, you know, working for them in the accumulated column here, in the accumulated value, but in the surrender value, they didn't have accessibility to that money. So as far as like when we talk about real estate investors, the IUL is not the policy to go for you because you cannot tap into that. So what I did here is I ran an illustration over here on a whole life policy, and so what I did, that's not the one I wanted. I ran a bunch of different illustrations. That's the one I wanted. Here we go. So this just goes to show you, and I couldn't get this dialed in completely the way that I wanted. I didn't spend that much time running the numbers perfectly. But ultimately, you know, you can see you put a lot less money into this contract overall. Because of the fact that you put $20,000 in the first year. But why am I putting 20 in instead of the 10? Is because of the fact that, like, listen, it's got $17,000 liquid out of it. So by, you know, out of the $8,894 that I put in for premium, which isn't the $10,000 premium, I'm able to have a higher liquidity number. So from a dump-in perspective for real estate, you can actually make a lot more of that money liquid in a whole life policy than you can in an insurance policy, because the surrender period is much more forgiving if you structure it properly. Now, then we got $8,894, let's just call it $9,000 for round numbers for the sake of our conversation here. So, you know, we're putting in about 10% less money every year, and then it drops off because of the MEC limits. And I could have messed with this to get it better, but we're ultimately putting in a lot less money, and even to the stress test level for the other policy, even putting in less money compared to the IUL, this gets you more death benefit, and it gets you about as much cash value, and you haven't even put as much money in. Now, is this guaranteed? No, but guess what? This is guaranteed. The 254 is guaranteed, and you can see there's not a huge gap there, right? Why? Because there's a 4% guarantee in this contract, and which is what I was running the other one at. And this is got actually a 5.25 dividend. Now, this is a company that for over 120 years has paid a dividend every single year, and their dividend is at an all-time low right now. So, like, I believe that we live in a world where interest rates are at all-time lows, and they have to go up. So if they go up, then the fixed market improves and dividend rates will go back up. So I actually believe that this policy has a high likelihood of performing better than I'm showing you over the next 30 years, over the next 25 years. And so that's really important. So when you look at the comparisons, and I could run numbers here, let me see here real quick. I got some personal information here that I don't want to share as I click back over to a account here. Oh boy, here we go. What is the actual return with all fees, expenses that you may be having your money in whole life versus a high yield savings account of 4%? Yeah, so check it out. So, and yes, I am working on I'm working on the Curtis Ray thing, man. I've got something really good. Do I have any advice for somebody looking for advice for infinite banking in Quebec? Yes, I do. I actually have one of the best IBC people in Canada who's licensed in Quebec. That is a buddy of mine, and if you want, I can get you in contact with him. If you want to talk to him, just email me chris@life180.com. I'll actually put it into the chat for IBC Canada info. I'll just do that. So just do that, chris@life180.com, and I'll send you information on that. And Jose, man, it's good to see you. I will be doing that very, very shortly. The thing with that video is it's very there's a lot of technicals to it, so I want to make sure I get it like really zoned in, because there's a lot of moving parts, and he uses a lot of moving parts to make it look amazing. And so I want to be able to break it down very succinctly, and I'm going to put together actually a series on it. So I think it's going to be really powerful. So anyway, that is that. Let me see if I can find. I need to get to this here. Give me 1 second, guys. I apologize. I should have had this down, but so is life. You know what I'm saying? I need to, no, I've got other stuff I've been doing for clients, so I got to keep this off of, I don't want to be showing. Where in the world is it? Can't seem to find it. Bummer. Well, I had another illustration that I was showing, and I had the internal rate of returns associated to it in the whole life policy. But at the end of the day, I'll tell you this: the internal rate of return in a whole life policy, the objective is to get it between 4 and 5% over a long period of time for the internal rate of return, after fees, after expenses, after insurance charges, after all that stuff. And if you can do it over a 25 to 30 year period, get it to that range, then you're doing really well. And if you structure it the right way, that's about where you should be. But once again, when you compare whole life to an IUL, the bottom line is it's not an apples to apples conversation. I do agree that index universal life is more of an investment alternative, and whole life is more of a savings alternative. But the problem is when you look at the fees, of in the moving parts of an investment, or the IUL as an investment, the problem is you got this. You have all these things that are going on, and you have the account value going up, and that's all fine and good. And the target premium in this is actually set up really well. It's low, $2,635. That's all you need to be paying to cover the cost of insurance. So it's going much higher than that. You're paying a lot more money, so that's going into cash growth, which looks really awesome. It's structured fine. This is about as well as you're gonna probably structure an IUL. I mean, there may be some things with different companies that you can do, but I'm not a big believer in using all those multipliers and different benefits, because they're all just gimmicks for the insurance company to make money. But at the end of the day, remember, they can move all these fees. One of the things I never talk about goes back to, actually, I'm going to scroll all the way up in case people just got here late. Let me see if I can find it here. Getting back to this right here. One of the biggest things I talk to people about fees is the loan rate charges. These illustrate at the current rates here, right? So policy year 1 through 10, they illustrate at 3.9 if you're doing a policy loan at a fixed policy loan, like a declared rate loan, which is basically a wash loan, right? So policy year 11 plus, they say the current is 3. That means it's illustrating at 3, and it's guaranteed to be 3.9. So I promise you, they're not going to lower it from 3.9 to 3. It's going to be 3.9, but the thing is, when you illustrate it, they build in 0.9 of a percentage point, 90 basis points of arbitrage for the illustration to perform better. And the savings of those expenses compound in a beneficial way for the policyholder, and it looks really good. But the bottom line is, when you add those extra fees in, it compounds against them with internal fees, and they're paying more and more loans on that. And that goes, that obviously goes the wrong direction. Now, any alternative policy loan charge will be charged current of 5%, illustrated 5%, maximum 8%. Now, they don't let me illustrate this with an assumed 8% policy loan. But the bottom line is, this is the strategy that they're using for the arbitrage built into the IUL. They're saying you're going to pay 5%, but you're going to earn up to 10% if that's the cap rate. So, downside protection, upside potential. But the bottom line is, what happens if you're going to pay 8% policy loan and the cap rate is dropped to 7%, which is very, very likely 25 years from now, by the way. So you're guaranteed to be negative arbitrage. You can never catch up. And so they don't talk about this. They illustrate it in a way that only benefits the policyholder. But at the end of the day, when I say these things will never perform according to how they're illustrated, these are all the reasons why. If you look at all the parts that can move and that the insurance company has the ability to manipulate, it's absolutely disgusting. And so when I say stress test these all the way down to 4%, right? And mind you, they're not guaranteed. And when you stress test them, even when it's not at a guaranteed level, you stress test this. Let me see. I'm in the non-guaranteed section here. That's good. When you stress test it to $10,000 a year premium, and mind you, that's I put in $250,000. Let me see how much did I put into the other policy here. I gotta check this out, because I screwed up. I apologize. My bad. Such like a noob move for a YouTube live, but nobody's perfect. So I'm gonna run numbers here really quick. I gotta pull this up. I gotta And so, oh, this is the policy I was thinking about. So, okay, so check this out. So if you did a 10, I did have it here. No, this isn't the right one, but it's closer. It's closer. So this one isn't even an efficient. Whole life contract. So what happened is this one only has $20,000 dump in with 14,000 liquid. This really could be 17,000. It was just something was jacked up. But the internal rate of return is actually going to be decent over a long period of time. So you can see here that this is with an assumed rate, but you can see the premium goes down, especially the last couple of years to avoid MEC levels, that this has got 400,000 almost in cash value after year 25, right? So think about that. And you get $870,000 in death benefit. What did you get in the other one? What did we have there? $506,000 in death benefit, right? So you're getting more death benefit. You're going to get more cash value because, believe me, this rate for the whole life contract, to be able to have this is based on a 5.25% dividend with a 4% guarantee. So the spread is not that much different, right? Like it's very close. And I would argue that if dividend rates go up, dividend rates, I should say, have a chance to go up because as the federal funds rate goes up and the fixed economy goes up and improves, then these will have a higher likelihood of outperforming. And in that same environment, the IULs will struggle. I've done videos on this. Go back and watch them. So I guess my point is, when you look at this, like, and you compare an IUL when stress tested to a whole life policy, and you look at the guarantees and you look at the realistic returns and what they're going to have and the lack of the moving parts, because listen, these are what they are. The company can't manipulate and maneuver and change all these different moving pieces on you. They can change the loan rate, it can go up, but guess what? The loan rate is only going to go up if the dividend rate goes up. So that's always going to be in unison. It doesn't work that way with an IUL. It just doesn't. And so it's just something to take into consideration. And so anyway, I don't know. Let me see here. I want to get back to you guys. So all right. So I got some questions here. I'm not sure if I should keep my emergency and my savings or open up a whole life. So yeah, man, I'm looking forward to the MBI review as well. So here's the bottom line. If you're not sure what to do with your emergency savings, I would say pick a number that you could afford to save in, like as a forced savings plan every single year. If you haven't watched the Life 180 Pyramid video, just Google Life 180 Pyramid or YouTube Life 180 Pyramid and watch that video. I think it's like 25 minutes long. I think it's pretty awesome. It'll explain to you why I think people should have their safety account, their emergency account in a whole life policy, but it's not where all your money should be. I think you should have, depending on what your account balance looks like, if you had 20 grand in a safety account, for instance, I think doing your first year premium of 20 grand into a whole life policy, and if you did like a $6,000 annual premium after that, you could actually take care of your emergency account plus the first year premium of that 20 grand. So like a $14,000 dump in with $20,000 or with a $6,000 premium, you could have that set up where out of that 20 grand, you're like $17,000, maybe 17.5 liquid, completely liquid. That's pretty awesome, right? And so if you do that, then you do $6,000 a year. If you can afford to save like $500 a month, it can perform really well. And you're not losing much liquidity, and you're setting yourself up so you're going to gain. You're basically investing in the system that's going to get better and better and better. It's going to be like a bank account on steroids. That's one of the reasons that I love it. Jonathan David, what's going on, man? 57 years old, where to begin? Need life insurance. So that's where you begin then. If you need life insurance, you begin with the life insurance. Jonathan, you can set up a call with me if you want. I can't sell you anything. I'm not licensed, but I'm passionate about this. If you want to, I can connect you with people. If you want to talk to some legit insurance agents that know what's going on, you can go look at the link below. There's actually a link in the description below to set up a calendar appointment with me. My Calendly link is in there. But the bottom line is, if you're 57 and you have an insurance need, then you have to take care of the insurance need first. And so that looks like different things. I don't know your financial setup. I don't know your financial needs. I don't know how much safety, savings, emergency savings you have. I don't know how much retirement savings you have and what your asset allocation looks like, and what kind of like all the moving parts that are going on in your life. But obviously, if you're 57 and you have debt and you have kids and you have a wife and you have insurable need, then I think you need to take a look at that, and you need to get the cheapest available option for that. Sometimes whole life comes into play. You're at that borderline depending on how you wanted to leverage whole life to save for your future, to be able to have as a flexible vehicle. I'm not sure if you're into real estate investing. I'm not sure. It's really a personal thing, but whole life may or may not be the right thing for you. It may just be a term play just to take care of a need. If you want to dive into that deeper, just have a conversation about the principles of what's going on. I'm happy to kind of have an overriding principled conversation around that with you and help you out with that. So that is that. But at the end of the day, here's what I know. I'll go back to what I was saying before. Index Universal Life is a investment alternative. Whole life is a savings alternative because they function completely differently, and I think that's where people are getting this all wrong. But here's the deal: if you're buying IUL as an alternative to investing, I think it's a really dangerous play on its own, because at least with investing, yeah, you have managed money fees, which I think are criminal. Managed fees, I think, were a great way for the financial industry to annuitize their business and to get guaranteed raises as they brought on more clients. And if you look at the total fees that you're going to pay your money manager over a 30-40 year period, it'll make you vomit. It's disgusting, especially if you accumulate any amount of money. You're taking on all the risk, and they're just getting paid an annuity based off your hard earnings and savings over the years. It's kind of horrible. But at the end of the day, what I would say is, if you're looking for an investment alternative, I would just buy the S&P 500 indexes, or B, one of the reasons that I use whole life is because I don't believe you should be taking your risk inside of the insurance policy. I would rather use a savings alternative, not an investment alternative, but a savings alternative. It's like a bank account on steroids that I can leverage, that I can access, that I have control of, that I can then invest in things like real estate, that I can borrow against, leverage, have all the benefits that come with it, and be able to access life insurance, to be able to access real estate and buy cash flow properties, take the cash flow from that, take the risk outside of the policy, and that's what I'm talking about. So, Kiz, what's going on? I'm a newbie, licensed in 5 states on the East Coast. I need to learn how to properly build policies so my clients can take advantage of this opportunity with whole life. Well, Kiz, depends on who you're currently contracted and appointed with. I'm not sure who you work with. Every company has different illustration software. Every company has different training, different support. It's awesome that you're here. It shows that you're somebody who's really interested in growing and learning and educating yourself. Okay, and if you need to do this for you too, I would say you need to take a look at. I'm not sure who your trainers are. I look at this 2 ways. I commend you for being here and learning, and I also worry for you, because if your manager or whatever isn't able to teach you this stuff, or isn't taking the time to do that, that kind of worries me about the culture that you're involved in. So I'm not sure who you're working with. If it's a career company, if you're with an independent shop, or like who you're appointed with and who you do your business with. I don't know what you have going on, so it's really hard for me to kind of give you any advice. But if you need to do this for you, if you want to take a look, if you want to build an illustration for yourself and shoot it to me, chris@life180.com, I'll look it over. I'll give you my opinion on kind of maybe some things you can do, depending on the company that's going on, that you're building the illustration with. Like I said, every company's a little different, but at the end of the day, that's one of the other things I love about whole life is the moving parts are few and far between. Like most of these companies are dealing with the same variables. The cost of insurance is pretty much the same across the board. They all kind of leverage different dividend rates. That's one of the reasons I showed you the company that I showed you with the whole life policy is the dividend rate is at 5.25, right? Like whereas Penn and Guardian and Mass, they're all illustrating at much higher dividend rates, and I think those are going to come down in the short term. So they're not going to illustrate at the current value the way that they're not going to perform based on the illustration of the current value. And I think that's why I showed you the one that I did, is because I think that the dividend rate is much lower, it's much more realistic, and it is what it is. So anyway, I hope this helps. I just was kind of running through this. I probably should have prepared a little more, honestly. I was just I got these in. I didn't look over them too much because I wanted to be fresh. I hate scripting this stuff out. I like to be able to just kind of wing it. And then I realized I messed up one of the whole life illustrations that I got, and it wasn't perfect. It wasn't what I thought it was, but it was close enough. I think we got close enough. I'll try to get it better and do an actual recorded video on it. But yeah, feel free. Anybody who's watching this, if you have any questions at all, my information is down below. You can reach out. If you're a life insurance agent and you're looking for help, that is what I do. I mean, I help advisors build their business online. I help coach advisors. I'm now the CMO of an IMO. So if you are looking for independent contracts or you're looking for anything, like, I don't want this to be a big sales push, but like, if you need help with anything, you can call me. I have access, to the tools, the training, the support, the marketing. That is my passion. I'm not licensed. I cannot sell life insurance, but I have access and training to some of the best people in the industry. And I train some of the best agents in the industry. And it's, I love what I do. I'm so passionate about this. I'm passionate about getting this out there to the world because I'm a big believer. We are coming into some serious financial challenges as a country. And I'm a big believer that whole life insurance is one of the most powerful assets that people can put their money in, because we call it the and asset for a reason, because it's not an either or conversation. It's an and conversation. It's a you can put your money in, keep it safe, keep it liquid, keep it accessible. You keep control of that money, and it's going to grow. It's going to beat inflation. It's going to give you all these benefits. And if you need to take risk to accomplish your desired results and the wealth that you're going after, then you can pivot and you can put it in real estate. You can borrow against it and buy real estate. If you're worried about the stock market, or if you want to take advantage of the stock market, or you're worried about financial crash, you're worried about the devaluation of the dollar, you're worried about any of these things, you can pivot out of the policy, borrow against it, buy crypto, buy gold, buy silver, buy anything you want, and it's super powerful. So, Kiz, yeah, dude, Anthony's my man. I love that guy. He's awesome. I was super stoked when I could finally get him on the show. I had to schedule that out like 2 months because he's so busy. And he and I worked on a project, I don't know, like 6 years ago, and it was awesome. And he's come so far since we first started working together and talking with each other and getting to know each other, and it's been awesome. And I would love to get his wife on. I want to get my wife and his wife and all four of us on a call at some point in time. I think it'll be totally amazing. I think it would crush it. And so yeah, that's that. But hey guys, so anyway, I think I'm gonna bounce. I'm hitting, I think, like 45 minutes now. So anyway, I hope you found this valuable. If you did, if you have any other agents that you think would benefit from this, go ahead and share it out. Share this with people. I think any Index Universal Life agent, anybody that's contemplating whole life versus IUL, it's not that IUL is bad, it's just about that, understand what you're getting involved with. And I hope this video gave a little more clarity on what you're getting involved with and all the different moving parts inside of the Index Universal Life illustration, inside of the policy in general. And yeah, that's it. If you haven't already, I would really appreciate a like. It really helps the channel out. And if you haven't already, hit that subscribe button. Make sure you click that bell. That way you get notified every single time I go live, every single time I launch a new video, which is pretty much 5 to 6, 7 days a week. Anywhere between 5 and 7 days a week. I try to get content out there. Depends on how my week's going. But anyway, that is that. Have a blessed, inspirational day. You guys have an amazing night. I will see you tomorrow. Take care.